So help out at 11 o'clock, Patrick. You come off mute, and I'll just say some welcome remarks, and then we'll pause for a minute for others to join, and then we'll start maybe at 11:01, maybe. Revelation.
Wait, think about that.
Sounds good.
Well, you might do some sort of review.
The only review we do is that the charge off the review. And if a loan, if we're gonna charge off a loan, then we want to send that loan. What they want.
Right.
That's what it's asking. I think technically what you're supposed to do, you're supposed to go out, pull credit on everybody.
Answer a million questions right now.
Not me for one.
I said, why aren't you with us? All right. 28%
Anytime you want to start, Ron, go ahead.
Yes, 4%.
Good. Good
morning, everyone. Thanks so much for joining virtually and in person. And this is Ron McLean, the CEO from the Cooperative Credit Union Association. We're going to get started in about 1 or 2 minutes. So, again, thanks for being prompt. We'll give some of your colleagues and peers from across our 4 states a chance to join shortly. And thanks so much.
That's this mic here.
I gotcha.
You want everybody to work.
Yes, see what's in the right hand.
Okay. All right, so I have 11:02, so we can go ahead and get started. Again, a big welcome to everyone. As I said before, Ron McLean, CEO of CCUA. Pleased to welcome you to a hybrid event. We are pleased to be live in Wilmington, Delaware, at the headquarters for Dex Day Federal Credit Union. We have an esteemed guest today. We have the Supervisory Examiner, Kevin Rocks, from NCUA. I asked Kevin earlier how many years NCUA, and it's approaching 40, but 37 to be exact. So a familiar face, certainly to many of our members. For our folks virtually today, if you can please go on mute as a courtesy to your other hybrid attendees. Put questions in the chat function if you're hybrid, if you're virtual. And Kevin's allowed for some Q&A at the end of his presentation. I also want to recognize the great folks and our partner friends at Dex Day Federal Credit Union. We have a number of them in person today, a number of them online. We also have their CEO, Jerry King. I want to give Jerry a chance to say welcome.
Well, good morning, everyone. We're happy to host everyone here. I'm joined today by Mary Brian Dooch, our CFO, Patrick Rhodes, our Vice President of Operations, will be driving today. And we have our Supervisory Committee Secretary, Zenaida Gephardt, here. And Haley Miller is our marketing coordinator, that she's going to make sure we all look good when she takes pictures. And I see joining us on the screen is Board Member Marie Davis there. So we are happy to host everyone here, and we're happy for the opportunity.
That's fantastic. Thanks, Jerry and Team Dex Day. So without further ado, I'd like to introduce Kevin Rocks, Supervisory Examiner for NCUA. Kevin, it's all yours.
Thank you, and thanks for the invitation. I'm going to work through most of the slides, but I like to go off script once in a while when we have some issues that come up that I can share, different things that we're dealing with, now. Presentation's been around for a little bit. The first thing is any opinions expressed are the presenter's own views do not necessarily reflect those of NCUA or the board. I've been told that after like 30-some years, I've lost my filler. So it's very good for me to read that, and I'm actually reserved. I don't know if this is a reminder or not, but
That was so you're spot
People-
on the camera.
people in the group would appreciate that name tag very much. So I will go off script a little bit with just some stories of things that we're dealing with, why these things are priorities. We'll not mention credit unions, but any of the information that I mention will be FPR related. It's public information. There's no secrets, nothing that's going to embarrass any credit union. I wasn't going to do anything about the organization chart, but I thought it's probably good just to touch on it really quickly. Many of you may remember Jay Walters. He was a regional director for many years. John's been the regional director, I want to say like 4 years maybe. He came in and was met right away with COVID. A really difficult time. He's really done a good job. Now, I will mention something else about John. When credit unions have to go to the regional director for approval or something, I know how I have to present because John is one that wants to get the yes. And he will really look at things every which way possible to try to make things work. So I actually try to go on the other side sometimes when we have to make presentations so that you can get the full picture of what is going on. He's doing really good. I think that most credit unions that have either applied for something, sometimes things get a little sideways, and they have to kind of ask for I was just going over some of the organizational structure of what we have. The biggest thing right here is we have 3 new directors, and they're called the Director of Specialist Resources. And the reason that they were created is because we have too many people in those groups, and we have 2 new specialty areas. We have specialists for capital markets, for IT, for lending, for new ones are consumer credit, and one's are consumer compliance, and one's gonna come from BSA, they're gonna be new. So we're taking people and putting them into these specialized areas where they get constant training, and they are getting experience in the largest, most complex credit unions. Part of their job is when they come out and work with us is to bring the specialists that we have in our groups up to speed. So it's been a change we've had this doing this for years and years, and they've just added 2 new specialists, which is probably one of the reasons that there are some vacancy announcements. But 99% of them are promoted from within, and they create vacancies in the groups. So we're talking about vacancies, and we're pretty good right now with examiners in our region. We're just filling in. We have some retirements coming up, and a couple of promotions that have yet to be announced. So that Mike's area is getting pretty crowded. Under Rebecca and Wendy, that'd be the next slide, it's just our groups. Just the regular SC groups, we all report to the ARDP, either Rebecca or Wendy. And the next slide is just where the regions are. Now, I've been around long enough that we used to have 6 regions. We went to 4. Now we're down to 3. So our region is now in the dark shade, the smallest geographical area by far. And the next group are trends. I don't want to spend too much time on the trends. When I first looked at this, I figured we were picking on Connecticut because I thought Connecticut was the only one that was there. And then it just kept on going state by state by state by state. And I mean, we work in a number of states, and I don't really get a difference between the state borders. Don't really seem to be that much of a difference. We had California for a few years in our region. That was different. I mean, they were very different.
Remember when you had Alaska?
We had Alaska too. Yes, we did.
Mm-hmm.
That was, the reason we did that is just an experience thing. That those states had very difficult times keeping examiners because of the cost of living. So they were shifted to areas where we had more experienced examiners. And the examiners weren't real happy about traveling to California as often as we did. Alaska was an adventure. No one was really not pleased to keep that, so we're glad that went back. And now we're basically in our own area. And it's nicer because when we need people for examinations, we can reach out to the other supervisory examiner groups, and we're getting to know the people, the other examiners a lot better. And it helps a lot with some of the continuity on exams. If we can have the same people, even if they're out in the same group year after year, it does really help. I guess the main reason for the presentation, we did discuss some of the supervisory priorities. And I know that John Kennedy, or John Cutchy, and some of the people in the central office have been really concerned with where interest rate risk and liquidity risk are going to merge into credit risk. We're going to see more problems now and into the future with that part of the business. Inflation and high interest rate risk putting pressure on credit union members. I mean, that's nothing new there. Everybody, I think, most people thought rates were going to be coming down a little bit, maybe now and definitely within 2024. Now that seems to be up in the air now, whether that's going to happen, or whether rates might even tick up a little bit more, which certainly would not help anybody. So we are trying our best is to look at the risk that took a lot of attention in the past year or so with interest rate and liquidity, and making sure that we don't walk away from the credit risk. The thing that we're seeing that's given us the most heartburn right now isn't on the slide. It's participation lending. We have large credit unions who are writing off large amounts of their participation loans. And it all goes back to doing due diligence up front, making sure you know what you're buying. We have seen loans that are being made to credit union members who are becoming members to get the loan. So they're not members that have been in your credit union for 20 years and have a sense of loyalty to you and maybe even just credit unions in general. And there's a lot of unsecured business loans that are becoming loan participations, and they're not working out. So the credit risk isn't just the typical member credit risk that you see. It's members that are coming into these participations. And a lot of them touch fintechs, they touch CUSOs, they touch credit unions, and sometimes they can be somewhat complicated in the relationships, whether we're talking about a loan participation or an eligible obligation. You need to make sure going in, because each one comes with different criteria and different rules. To give you a quick example of a participation, we had a credit union, small credit union, bought a participation from a very large credit union that's not in our region, and it violated the regulations. Like, it wasn't even close. And they bought two of them for a tremendous amount of money. Like, if these participations had a lot of problems, the credit union would most likely run out of net worth. So it was a major problem. We had to do a lot of analysis on loans. They had to ask permission to be able to keep the loans for a little while because they were performing. And it came down to the point that we just had to monitor that place, and it's put them in a very difficult situation because they're of high-risk loans. The loans they bought are like the high level of high risk. So we're hoping for the best. It's not a tiny credit, it's not a large credit union. And we're sitting on that for as long as we can to hopefully they can overcome the problem. I mean, they did everything they could possibly do to return the loan to the seller. Now, the contracts that are written are usually pretty ironclad. Those loans are not puttable. You cannot give them back. And they're your loans. I mean, unless you have some kind of options written into the contract, you got to keep them. The large credit union could have bought these loans back, and it wouldn't have been a drop of the bucket. But they refused. I would wish that credit union was in our group, but it is not. And this credit union is going to have to just try to live with that. And it's not like the other credit union was trying to create a problem. This credit union to merge them in. They have no desire to do that. That's not part of the plan at all. But that's where we're seeing a lot of the risk is in loans that aren't being made to your members. And it's important, your due diligence level really has to go up. And the other thing is, some credit unions buy these loans, and they're not even in their own policies that they can make the loans, but they have to be loans that you can make yourself. So if you have a policy where you don't make any business loans, you can't buy business participation. So the regs, there's, I think it's under 123, 24, 22, and 23. One's participations, one's eligible obligations. You really need to put some time into those regs before you put any more participations. CECL seems to be pretty much a non-event now, after years of having it delayed and pushed back. It finally came. It doesn't seem that it's been that big of a problem. Yeah, look, we're not seeing a lot of issues with loan workout strategies anymore. We're not seeing that. We're seeing that mostly the credit risk is the typical credit risk, some higher risk loans, some credit unions is typical business. And we haven't seen a big change in the loans that we look at. I'm not looking at reports and seeing page after page of loan exceptions. We're not seeing that. Which is good, because the thing with where interest rate risk leads to liquidity risk, and all of a sudden you're borrowing and you need more money, you make higher risk loans, because you can charge more. There's higher risk loans, and that just adds to the problem. We haven't seen that. I'm hoping that we don't. I will tell you about one loan program that I hope nobody else is going to join into, but credit union, when rates were pretty low. You're not going to do this, are you? Thank you. They offered a home equity program at 99 basis points for the loan. So the APR was less than 1%.
And we're not gonna do that.
And they were surprised that the program grew pretty quickly. And they had no idea that they were gonna end up with these loans on the books that aren't paying. I mean, what can you do with a loan that's you're charging less than 1%? Now, fortunately, they stopped, but it was after a significant dollar amount of loans went on the books.
Was it fixed rate, Kevin?
Yes.
That's a definite now.
It was not like a teaser rate where it's going to be 99 basis points and then linked to prime or something in a year. No, it's a fixed rate loan.
Wow. Dang, I wish I got in on that deal.
I did, at the board meeting, I did have to ask, well, what were they thinking? Like, was there a plan or something? And they just wanted to grow up. That was their thought. I don't know how you do that. So we still see some of those different things that happen, but typically with credit risk, we haven't seen the interest rate and liquidity risk become credit risk yet. But there's still a lot of people that believe that's the next problem. Liquidity risk. I would say for the first 25 years I was with NCUA, we used to try all these different ways to try to figure out a ratio to try to measure liquidity risk. We weren't very good at doing it. Now we're down to using something that's, it's a good starting point, and that's all it is. It's called the cash and short-term investment ratio. It's cash that you have and investments mature in less than a year, which is it's a good proxy to take a look at in the beginning. What it doesn't tell us is what other liquidity options do you have. Do you have a great real estate loan portfolio and you have a history of selling real estate loans? Lines of credit. You have lines of credit with corporate, with the bank, with the Fed, where it's no longer available now, but the term funding program with the Fed, that was around for a little while and has recently stopped, where you could pledge your investment portfolio at face value. It wasn't at market value. It's a nice deal for a lot of places to get liquidity. That's gone. I don't know if it'll come back. I don't know. We haven't heard any word of it possibly coming back. But it was nice. But most credit unions, even the small ones, do have some kind of relationship with their corporate. They have a line of credit. but the cash and short-term investment ratio, that's just something we look at, because if you have very little there, that's something we have to look into and say, why? Like, what's going on? It's like, if you go into a small credit, and delinquency is really high, it might be one loan, it could be one car loan. So, you have to always look behind the numbers, and the ratio is just a good starting point for us to look at. And if you have a high one, we probably don't usually spend a whole lot of time with liquidity, because you have the money available. I mean, we actually have one very large credit union that has maintained cash greater than, I think, the second largest credit union. So they kept billions in cash. Genius idea. They had no interest rate risk. And short-term rates have been so good, they've been able to make money on that money. So not everybody has that option. Not people have, more loan volume. We have been pressing more and more for liquidity analysis, in-house analysis, cash flow analysis, shock analysis, taking a look at how your members are behaving. Are they staying? We've had credit unions increase the cost of funds to keep members, and it would be cheaper than having to go out for either non-member deposits or borrowed funds. What we look for is, well, what is the plan? How are you going to approach your non-basic cash that you have in your corporate? What are you going to do to handle if members want money? And now the fear is that because of what happens to the banks, that it becomes a social media event. That if somebody hears something about a credit union, it goes on social media, and all of a sudden you have people on their phones pulling money out of the credit union. And you don't even see them. So that's something that you need to be prepared for. That, I shouldn't be glad that it happened to banks. It's bad that it happened to anyone, because eventually it hits members or customers if you're in a bank. But it's something that we needed to be aware of. And we started looking a little more closely, like what are you doing if an event happens? And we've looked actually internally what we would do. I mean, I remember the board chair came to a meeting with us, and we were talking about that question, like, what do we do if we have a systemic issue? Like, what are the plans? And I think we used the Treasury in the past, and I think we probably use the Treasury again. But we had to look at that, how we're going to handle that if it becomes a larger than one institution event. And we've had issues in the past with credit unions, the smaller credit unions, and the larger credit unions stepped in, because they care about credit unions, they care about their industry, and they care about themselves also. They don't want that news to go out. So it's always good for the credit unions to come to things like this and network with other credit unions. So we're still working through liquidity. It's definitely more of a priority than it has ever been. It's probably going to be that way for a while. And you have to make sure that you have good plans for it. We have a credit union that it just happens. They don't have tremendous loan volume, and their investment portfolio isn't out that long, so liquidity was never really an issue. But they've just put out a easy-to-access share account paying 4%. Well, in a very short time, that account grew to $100 million of money that they don't really need for loans. And they're in the process now trying to figure out how much of that money walked in the door, because that's going to really play games with your net worth ratio, versus how much money just moved from regular share account into this high yielding account. And what happens if you can't afford that down the line? Is that member who's been in here forever in a regular share account just become hot money that's going to go chase that money somewhere else, which is another liquidity risk down the line. And we have not gotten an answer about why the other credit did it. That exam is actually in process. It's one of the things we're going to talk about, but it's still there. It's an issue. But it could have been just that they just really wanted to hedge their liquidity to make sure that they had no liquidity risks. And maybe that's part of the plan that they have. We haven't gotten to that level yet. The examiner called me a little bit upset about the change in the balance sheet so quickly, and obviously gonna have an impact on earnings. You're going, paying 1% to 4% on $100 million. And it's a lot of money. But borrowing's expensive also. Non-member deposits are expensive also. And you have to have plans to pay all that back, or you have to have plans for that non-member deposits to walk out of the door. Interest rate risk. This has been my favorite area since very early on. I remember going to Atlantic City for the League of DuPont Credit Unions. Do you remember that?
Yes.
That's something that not only could DuPont Credit Unions have a league, there were so many of them. Now there's a handful?
There used to be 35 DuPont credit unions across the United States. And it was an acronym. It was ACU, Association of DuPont Credit Unions, and it's since been dissolved because there's a handful of us left.
Yeah. I mean, it changed, and that was when you talked about what this interest rate has helped cause is the reduction in the number of credit unions. And one of my biggest pet peeves forever has been that credit unions will hand us an ALM report and say, here, it says we're low or moderate risk. And they pay for these models, they pay for the reports, they pay to outsource it. And they don't really use the model for what it's supposed to be for. ALM is all about managing the balance sheet. What if we do this? What if we do that? What if the shares do this? What if the shares do that? We have vendors that go out there and say that you can keep your regular shares and make real estate loans with your regular shares, because those shares are never going to leave and they're always going to be a low cost dividend. Now we're seeing those low cost dividends more going into CDs or money market accounts. That should all be modeled. I mean, the modelers should be doing that also. They should be recommending things. There used to be a group called Myers Cole. I don't know if they're still around. I think they're a different name. I think they've been purchased by somebody. But their whole point was, they didn't really like NEV. But their point was, if something happened before, it can happen again. So they never did models by raising interest rates up 1%, 2%, 3%. They would do 5%, 6%, 8%. They would really kick your balance sheet to see where your problem was. And there was a lot of value in that, because then you could see where or when you might have a problem. So what we're using now are income simulations and some type of NEV model. Now, income simulations are usually a little bit easier to do because you're not putting values on things and maturities on things, because you know how much money's coming in from loans, how much money's coming in from investments. What an income simulation should tell you is when you might have problems. Like if rates go up, how much time do I have to make adjustments? If rates go down, how much time do I have to make adjustments? The NEV model should tell you where your problem is. You should be able to look at the report and say, here's where we're losing value. A really good example of it was an error in the report, but it made it really simple to understand. But credit union had a type of a real estate loan. Say it was like $5 million in that portfolio. And when it went through the model, the value came out as 0. So obviously they made a mistake, they didn't value it. But that automatically should point, like, there's our problem. We just lost $5 million in that loan category. Well, maybe it's 100 million to 95 million. But this should show you, when rates change, where the value lost is. And those two pieces you need to kind of put into concert. Where are your pain points? And how long do you have to try to mitigate that risk and maybe make some changes? And it's difficult. I mean, your ALCO, it's a tough job to try to stay on top of that, because you have all these other factors coming into that now. You have interest rate risk changes. You have to shock things. You have shares. Like, how are you going to handle your shares? That's the big thing I'm asking the credit unions now. Like, how are you going to handle your core shares that you always said were always going to be there and they weren't ever going to cost a lot? Now we're saying they might be there, but they might cost a whole lot more, or they might be leaving. We're seeing both. We're seeing money leaving credit unions, and we're seeing money just staying, become higher priced. Either way, you need plans to how you're gonna handle that. You're either gonna have more cost on your books, or if you have, depending upon if you have loan volume or not, maybe some of that money leaving isn't a bad thing. Now, I was told early on in my career we had a management meeting with CEOs of the biggest credit unions in the region, and they said, if we don't grow, we will die. And I was shocked, because these were like the big credit unions. That was their philosophy, we have to grow. So I think over time, everybody has to grow. There might be some times when you need to retrench a little bit. Maybe that's one of those times now. But for some credit unions, it is. They don't have a very high loan-to-share ratio. You don't really need to attract new money. What are you gonna do with it? And I'm a firm believer in that growth. They convinced me. And I was a little shocked to hear those CEOs say that, because I thought they were like the kings of the hill. And they had all the assets, but they were saying, no, we need to grow. And they were right. They were probably $50 million credit unions then, and now they're probably the multi-billion-dollar credit unions now. So interest rate risk is just a very difficult concept to grasp. I used to try to show it as how you're really just trying to find out what the present value of your balance sheet is. And it's just basically doing the present value of your cash flows. And models, that's what models basically do. And then you say, well, what happens if investments are called? What happens if loans are prepaid? They run all those different simulations. But you're paying for that. You need to really get the bang for your buck out of that, and make sure that whoever's doing the modeling, in-house or a vendor, is giving you what you need to make decisions. Because this is really important, how you're going to manage the balance sheet. CFO of a credit union long time ago told me, if you want to not look at the model and just look at a number, look at the net interest margin ratio. And I have always done that. He said, the net interest margin ratio is strong and stable. The credit union is probably managing their balance sheet. And it makes sense, but it's really the income you make from loans and investments minus your cost of funds. How you are actively managing the funds that you have on your balance sheet. And it's not the only answer, that would be our only ratio, which would make life a lot easier. But it's a nice thing to look at, and I always look at it. I look at that, and I look at loan growth and membership growth. If you have negative both there, I always question if you're still being relevant to your members. If they're leaving in not shares, but bodies, membership growth and share growth. See if you're remaining relevant to them. But we spent years saying interest rate risk could be a highlighted area, and unfortunately it became a highlighted area. Nobody really wanted to have that. We do have regional capital market specialists. They are people that only work with models. They provide added value to the examinations if and when we can get them, because the whole region wants them. Our capital market specialists will be leaving the agency pretty soon, unfortunately, so John Fred, we've worked with John. He's a very experienced and very good capital market person. He'll be leaving. Yeah, I've tried everything. I tried everything to keep him around for another year or so, but he's ready to retire, and he's gone. Fortunately, we have two people that want to fill that spot. And one of them has experience with state banking. He's a lot of experience with capital markets, so he's probably going to be the next one. But for our bigger jobs now, we're trying to bring in help from the outside whenever we can with these regional capital market specialists. I think we have 9 of them for the region, so it's a little bit difficult. And something that's not on here, but what happens when the reason we don't get them is if a credit union submits an application for subordinated debt. The capital market specialists are the only ones that we have that are really qualified to review those plans. Some of those plans are in the hundreds of pages. And it's usually a very significant borrowing transaction that they're anticipating. So we lose them for that. So if you don't have one, it doesn't mean that we don't think the interest rate risk is important. It's just that right now subordinated debt is one of their priority jobs to do. I hate to leave interest rate risk, but information security, cybersecurity, a lot of it still boils down to the simplest things. In the past week, the CEO of a small credit union got an email that said, you have been hacked, click on this for virus protection. The next day, he's getting a message from his computer that his PIN doesn't work. So he clicked on the message and the attachment. He lost access to his computer, which was the sole computer that had their data processing system. So, it's the simple things. It's the same thing. It's why you need to train the people who answer your phones and your tellers, because they're really good at social engineering. They're good with these phishing attempts. I get messages, I gotta look twice. I don't know who it is, because they make it look really good, like it's an internal NCUA message, and it's not. And if I don't know it, I flag it as phishing and send it up the line. But this person just did, and we have it all the time. It's not just this one little credit union, it's human. It's human error more than computer error. And this person, again, this is an exam that's in process. It's, they are going back. The other point is they thought they were backing up to a thumb drive. But the backup is being redirected to the since wiped hard drive. So they have no backup. I talked to the data processing company, and they said, oh, we know who you're talking about. I didn't mention the credit union or the name or anything. But we know. So we talked to this person. We went through every thumb drive they could find. There's nothing on there. So they are going back to 2021 and having to manually input each transaction. Now we're worried. The next step is member notification, NCUA notification, because PII was on that system and we don't know if anybody has it. Maybe it was a ransomware attack and they looked at the size of the credit union and said there's really nothing here to ransom. It's a small credit union. It's a big problem. And that's the kind of thing that can turn into a liquidity event overnight. They need their money. We had another case where in a federal building, the credit union was told their data processing system was no longer acceptable. They had to take it off. So fortunately, the ex-treasurer board member is phenomenal and had plans already set up to get a separate server, and they were down for maybe a day, and they could handle a day manually, and it wasn't planned. And I told this person that, I said, you missed your call, you should come work with us. And she did unbelievable amount of research, she made phone calls, she had, yep, this is happening, I'll let you know, and she walked through everything she was doing. And we really didn't have many questions for her, just like, well, do you need help? Like, is there anything that we need? Yep. So, we see all different issues, but the cybersecurity is coming down to a human issue. Now, we also had a credit union last week, a large credit union say that their next exam, they want no IT findings. I say, good luck. And it's not because they don't have a very good IT program. It's just that things change so quickly. One of the value added that we bring is you might not be doing what another credit union is doing. And you should look at that. And it might not be an exact examiner finding, maybe it's in an overview, maybe it's in a supplementary facts, but you're going to have issues because the pace of change is just too quick. Consumer financial protection. Our board chair, and I understand the new board member, who I haven't met at all yet, was obviously very, very, very cognizant of protecting consumers. So we now have a soon-to-be-announced new consumer compliance specialist. Not sure how many we're going to have. It's not going to be a lot of them to start. But the program, the infrastructure in the region's all been set up. They're already come into a group. And they will be out working in probably our more complex credit unions. We do have a separate fair lending examination program that goes on, beyond what we do. They will come in during an exam once in a while, but a lot of times they do an independent fair lending exam. We're not sure how they come up with their credits they go into, but, they're very good at what they do. They've helped a lot of credit unions make some changes, things they did, maybe something on their website, maybe a loan program that was not completely compliant with regulations, that they can make kind of easy changes and get back into compliance. So that's been a very positive thing. So if you get a fair lending exam, don't worry about it. I mean, they're really good. They can find problems before they become issues for you. Okay, small credit unions. We do have a program now, and small, we mean 100 million or smaller. That's our definition of small for this program. But if you need help outside of an examination, you can reach out to the examiner, to the supervisory examiner. It might be clarification on points during an examination. That you get the exam, it kind of makes sense, and then when you're thinking about it next week, it may not make sense. We have time budgeted for examiners to spend time with you. It's been great with smaller credit unions. Sometimes the requests tick up a little bit with the call report. I remember when the call report used to be maybe 4 sides, and you should manually do it. And in Pennsylvania, the league used to have people that came around and actually helped you do it. That, I know, I'm old. But it's complex now. I go in and look at call reports, and I'm going through page after page after page after page. And if one line item is wrong, we hear about it. It comes back to us, and we have to contact you to go back and fix it. It might not be a real material thing, but it comes down, and we have to report back that has been changed. I mean, call report data should be accurate because it becomes our financial performance reports, and it's important because we see the trends in the industry. You can go and look at the financial performance reports for any credit. It's on our website. So we do look at that. For this NDI program, it just started last year. And for this year, 2024, I think they increased the budget slightly, and I think for next year, they're gonna increase it a little bit more. It's been really good. It's been accepted by the agency, because it's before, during, after an exam. There's no real time on it. And we've had a lot of places we needed help with liquidity policies, some lending policies, like I said, the call reports. We've had a lot of credit unions with record-keeping issues in the past few months. This is not gonna help that, but it can help you on getting in the right direction. We're working on more than a couple credit unions that records have become an issue, which is, for our industry, is an odd occurrence. But if you don't have records, what do you got? How are you gonna make decisions? So I'm gonna wrap up right there, and if there are any questions?
Kevin, thanks so much. You covered a lot of ground in kind of a really condensed period, so thank you very much. Want to pause for a second. So anybody online, if you have a question you want to submit, please do it via the chat function. And then anybody that's in person here with us today, welcome any questions as well. So let me pause for a second if any questions come in online or in person. Patrick, you're supposed to put any questions virtually.
I'll ask one.
Yeah, Jerry, please.
Kevin, you had mentioned, loan-to-share ratio. What does the agency consider a sustainable ratio range?
I don't think we have one. We've never really looked at that. We looked at that as, where was it yesterday, where was it now? What changes happened? We see your loan-to-share ratio really spike up, like why? Is it generic loans or in-house loans? Is it participation loans? Where did that go? But we have credit unions that have accumulated a significant amount of net worth, have a very loan-to-share ratio or a loan-to-asset ratio, and they operate well. So it really depends on what fits each structure.
Who's online? fine, Patrick. Again, folks virtually, if you have any questions, please submit those. Also, again, pause for a second internally here.
Yes.
I'm relatively new to the credit union, so you alluded to retirements, your capital
Yes.
specialist going to people moving into that, and also to some other folks that have retired. I'm wondering if you could talk about what the plans are in terms of personnel and how that may impact credit unions and how we could adapt to that.
Thank you. That's a good question. I actually wanted to bring that up. We have had people retiring and people going into promotions. For us, it is brought on a lot of new examiners. And the talent that shows up for interviews has been incredible. The last two people that joined our group, I remember interviewing the one young lady, and I'm thinking, we got no shot. It takes us kind of long to go through the process. She wasn't going to be around when we got back to her. But fortunately, she was. And the young man we hired, he comes with credit union experience. He worked in a credit union. Now, he got a couple special therapy classes to learn how to see things correctly, but once he's since come back and he's been really good. So we've been really fortunate. And I think that the number was over 30% of examiners in the region have less than 3 years experience. But some of them are coming with a ton of experience. Maybe 20 years ago, those examiners would have all been coming out of college. But now we're getting people with CPAs, we're getting master's degrees, we're getting credit union experience, we're getting bank experience. So we have people coming in that are once they get to learn the credit union side of things, they're plug and play. And they have to learn our exam system. It's a difficult system to work with sometimes. But as far as the knowledge is concerned, we're hiring great people. I'm hearing more of an issue on credit unions that are having more difficulty staffing. Well, it's gonna take our staff on that. But we do hire, our region is pretty well staffed right now, but that means we do have vacancies, because like I said, we have one retirement definite, we have one retirement highly likely at the end of the year, and a third questionable. Plus, in the group, we have people that easily qualify for promotions. And if they should want to become one of these specialist positions that comes up, we'll be down to 4 people. So we do have constant turnover, but it's, right now, for whatever reason, it's slowed down a little bit.
Kevin, you mentioned earlier the term fintech, which is a kind of broad term now, for kind of loose term, if you will. What kind of guidance do you give to credit unions that are looking to partner either for the first time or more with fintechs? And then secondly, as more credit unions utilize AI to some degree within their shops, I would imagine that the regulator, NCUA, would want to make sure there's no practices built into the algorithms that might be perhaps anti-consumer or discriminatory or whatever it is, but maybe some thoughts on those two topics.
The fintechs, you're dealing with a company that's out to make money, and that's all they want. They're not caring about you. They want every contract to be in their favor, and you need to really do due diligence. Because another credit union is using them, because a QSO is using them, that's not good enough. It isn't. And it's going to go back to reputation hit on credit unions that are facilitating some of these transactions. The AI part, we have something that has come out of the fair lending exams, where some of the things that are built into the analysis might be, say, age-related, that you can't have in your lending program. And it's up to the credit union to really go through all those steps that are sitting behind the decision-making process. The one we're seeing is in the automated decision-making process, where they're not customizing it, and it might have something in there that does not comply with federal regulations. So that's the only place that we're seeing it right now, but it's important that you look at that. We don't always see that in exams. If we know that it might be an issue or somebody is using an automated approval system, we'll have to look at it to make sure. Because usually the tweak is just, it's an easy fix. But if it's not, it can become, there's been a lot of attorneys that have been looking for class action lawsuits and things of that nature. And if you can just make sure that your systems don't open that door for a possibility, it would help. But I haven't seen a lot of AI. I don't know where that's gonna be in our agency. If that's gonna be with the IT people. I know some places are having their own separate AI divisions. I don't know that we have the capacity to do that. I mean, I'm not sure, but it certainly is a topic that it needs to be looked at.
Patrick, again, any questions online? Again, if you, folks that are virtual, if you have any questions, please submit those via chat. Maurice, is there a question?
Yeah, I have a question. Kevin, thank you for being here today. NCUA, we all know, is a regulator and an insurance company, okay, because ultimate goal is to protect the insurance funds. And so the question is, at what point does a credit union become a risk to the insurance fund? Because lately, we've seen a shift since 2013. A lot of credit unions, there's a shift to Camel 3. So there must be issues. What does the data say?
The rest of the fund is difficult because the fund's large. Not many credit unions are large enough to really turn the tables on the fund. But as the insurer and the regulator, if there are losses, you're the ones that are paying for it, right? So we do try to maybe be conservative stewards of the fund. And I think that's a good thing. Because when we had the issues with the corporates, the premiums came down to you. And we don't want that to happen ever again. So we do try to be a little more careful and treat every credit union that could possibly cost money as a possible risk to the fund. And if we haven't had an involuntary liquidation in a while in our area, but they're extremely expensive. I mean, they cost, a lot of times it costs way more than the asset size of the credit union. So we do try to be a little more conservative with that and say, well, we know a credit union isn't going to cause change the share insurance fund's balance tremendously. But it is important that we try to not have losses to the fund because it's your money. We try to be fiduciaries for that and make sure that we don't lose money. So there is no real point. We try to treat every credit union as its own going entity, and we want to keep them going entities. The migration to threes, I think, has been a function of the interest rate scenarios. The difference between a 2 and a 3 is a 2 is we're not going to really allocate or budget time to look at that other than process your call report and look at that. If it's a 3, it means we're going to spend maybe off-site supervision. Well, you have findings, you have a door, you're running a new model. What's going on? And we want to find out what's going on. Most of those contacts, there's not a lot of changes to the risk ratings or camels. It'll probably never happen in an off-site contact. But we do like to keep in contact with the places, and that's, a Camel 3 is our budgetary tool to do that. And if we never had to tell a credit with a Camel, this rating is again, I'd be happy. Because it's rarely, there's so many credits that we've discussed points and come to agree with points. What are the issues and what are the resolutions? And then they don't agree with the Camel, but the Camel gives us a chance, manpower-wise, to be able to say, well, we're going to go back and visit that place, or we're going to do an off-site contact at that place because we want to stay on top of it and not let things get worse. So I would not worry about your Camel ratings. If people used to say we can't merge somebody because we're a Camel 3, yes, you can. You can apply to merge. And I did want to mention mergers, but we have seen very few mergers, at least in our area. It's a wonderful thing.
Good.
And a lot of times credit unions get mad because we didn't bring a merger around, but 99% of the time, the credit unions have already talked to the continuing credit union. But before it comes to us, and we get the application in the mail. I think that's kind of gotten out there now that if you are an acquiring credit union, you need to be out there with other credit unions and networking a lot more.
Great. We have 2 minutes to go. We'd like to end on time. And Patrick, before we have a final question, any questions online?
No, nothing online, Chris.
So, final question, sir.
Okay, thank you. Very interesting topic that Maurice brought up, camel rating, and I think, Ralph, you know my position on that over the years. So I won't go into that, but it's an excellent question, and, we appreciate the response. What, you did mention, about the small, credit union initiative that the NCUA does as well. I'm familiar with that, especially, I think it was a great program that they had, probably still have in existence. Back a few years back, I used to attend them, that they used to have, because I was also, on the supervisory committee at a small credit union, credit union. And so at that time, American Spirit was not, considered a small credit union at that point, but then they raised the bar. So the information I received there became beneficial, going forward. My question to you is basically, what initiatives now that NCUA does that can help credit unions? I know things have changed over the environment, so some examples of things that small credit unions can benefit from.
Good question. This is the time we're spending now in the small credits is our main initiative. We used to sponsor workshops, and we haven't had them for a while. I don't know.
Yes, those are the ones that I attended.
We used to have,
They were excellent,
yeah.
all that.
I remember that we had a lot of them, and we had a division with economic development specialists, and that division isn't around anymore.
And we do have a CURE division for expansion and up, but they don't have the people that are out in the field, which is the missing, I don't know.
That's a missing link, because.
And maybe, if you talk to a board member or so, you might want to ask them that. But they were good programs, they were very good programs, they were always well attended, there were good presentations that were made. And the other thing is, there was a lot of networking.
Right, it was.
Now, I know in Philadelphia, there used to be
That's it, that's what I'm talking
a
about.
lot of no, they weren't informal, there was a credit union league,
Mm-hmm,
used to have chapters that had meetings.
yes.
And in Philadelphia, the people that ran the chapters were no longer there,
Right.
and no one stepped up.
Yeah, I was part of that initiative because I'm
Yeah.
affiliated as well, so.
But I missed those workshops, they were really good.
You were great, right outside the airport, it was really held. and
Yeah, yeah.
Nice hotel and what have you, and it was well attended, and it was
Yeah.
an educational program, and of course, they were interactive, so you could ask specific questions as well.
Yeah.
So, thank you. I would have to see that initiative going on again. Good night.
Excellent question and comment. So we are at noon time, so I'd like to try and end on time. So a couple of closing comments from CCUA. We'll be announcing our free BSA training online virtually in the very near future. Really excited to be back kind of very close to Delaware. We're taking CU Accelerate on the road May 3rd through the 5th in Philadelphia. I'd love to have people still sign on and register for it. After that, in early June in southern New Hampshire, in Bedford, New Hampshire, June 3rd to the 4th, we have FinTech Connect. Talked about FinTechs earlier, great opportunity to interact with some FinTech leaders. I want to remind our membership that our professional development training is open. We have boot camp, we have developing great managers and other programs. So please check out the CCUA website for that. And a couple questions about small credit unions, and we do a lot for the association. Please reach out to us. But one I really want to emphasize is we have money to give. If you are below $200 million in assets, we would love to send you a CCUA small credit union grant. And the money's there, and we'd love to do that. So please reach out to CCUA. So on behalf of CCUA, a big thank you again to Jerry, Dexday team. A big thank you to Kevin Rocks. And we'll wrap up the hybrid portion. And to our hybrid members, thanks so much and have a great day.
Thank you. Good job.
Thank you. Thank you.
How, for a picture with Kevin. We have Kevin, do you have a time?